Hello and welcome to our chapter 2 of online transfer pricing course. You are listening to CA Gaurav Garg. In this chapter we are going to cover Model Tax Convention Article 9, which primarily deals with transfer pricing. Before moving forward, let me clarify on a couple of queries. One, whether we're going to have practical case studies or not. I wish to confirm for sure we're going to have practical case studies to understand practical aspect of transfer pricing, but those case studies will come as we'll move forward. For example, when we will be discussing the transfer pricing methods, I will ensure that as many case studies I can put, I will try to put case studies in the transfer pricing methods. Second query was how you can connect to me if you have any query. It is very clearly written in the email, but I'm repeating it. You can ask your query or through WhatsApp, through email, or you can directly call me based on the time slots which are given in your emails. Thank you. Let's start this chapter. Agenda. So the only agenda in this video tutorial is to understand Article 9 of Model Convention, that is OECD Model Convention and UN Model Convention. So the first question comes, tax treaties. What is tax treaty or double taxation avoidance agreement? You must be wondering, earlier I was saying that we were going to discuss tax convention, model tax convention, and now I'm starting with the tax treaties. So don't worry, we'll move on to model convention very shortly. So initially, I'm talking about 1930s or 1920s. So when country, they used to trade with each other, they used to have head office in one country and branch office or affiliates in other countries. And there used to be trade between those head office and branch office. In addition to the trade that head office used to do directly with the independent parties or third parties, they also used to do transactions with head office or affiliates. So in the initial period, there used to be only one article which used to deal with both transaction between head office and permanent establishment or branch office, and transaction between affiliates and the head office or the parent company. Why this article is needed in the tax treaties, or what is the purpose of tax treaties, that we're going to discuss. But we need to understand, when two countries are trading with each other, there could be tax issues. If any country wants to collect a tax, they primarily looks for connect. So there could be two kind of connects. One, the connect based on the source, and second, connect based on the residence. So when, let's say, the head office, which is based out of India, is transacting with its branch office in Singapore, so there is a source in the Singapore and the residence is in India. So India will collect a tax on the global income, whereas Singapore will say that being source is in Singapore, I will collect a tax on that income. So we entered, the countries entered into tax treaties, and the various articles in the tax treaties basically decide the allocation of rights, that which country will collect tax on which income. So similarly, we have articles with regard to transfer pricing provisions, article with regard to transaction between head office and the branch office. So we're going to discuss those articles, not what is written in each tax treaties, but what primarily this tax convention, the model tax convention of OECD and UN. OECD means Organization for Economic Cooperation and Development, and UN, that is the United Nations Tax Convention, talk about. So what is tax treaty? It is a bilateral agreement which documents taxing right of each country. Taxing right could be divided based on residence rule, source rule, or mix of both. Clarity on taxing rights avoid double taxation and helps in increasing international trade. Article dealing with transfer pricing, probably most of you would be interested in this. So we have broadly two articles. One is Article 9, which talks about associated enterprises or transaction between two associated enterprises or two related parties. And then we have Article 7, which talks about attribution of profit between head office and permanent establishment. So initially there used to be only one article, but later on the article got divided into two. One is Article 7 and Article 9. Article 7 talks about the business profit and Article 9 transaction with associated enterprises. In both the cases, transfer pricing provisions are applicable, or the concept of arm's length price is applicable. In this video tutorial, we'll primarily going to focus on Article 9 associated enterprise of OECD Model Convention and UN Model Convention. Let's see what Article 9 says. So para 9.1, where an enterprise of a contracting state, for example UK, participates directly or indirectly in the management, control or capital of an enterprise of the other contracting state, for example South Africa. So what we are discussing is how or when this transfer pricing provisions would be applicable as agreed between different countries or as proposed in model tax convention. So you will generally find these wordings which are given in the model tax convention, OECD or UN in your tax treaties with different countries. So let's understand what tax treaties are talking about. Sorry, not tax treaties, rather model convention. So the first para, that is para 1 of Article 9, Part A, says an enterprise of a contracting state, for example UK, participates directly or indirectly in the management, control or capital of an enterprise of the other contracting state, for example South Africa. Similar paragraph is there in United Nations Manual also. Let's understand this. They say company A of UK and we have company B of South Africa. So the relationship is that company A is participating in the management, control or capital of company B directly or indirectly. So if this condition is satisfied, there is a special relationship between company A and company B, and we will call company A and company B as associated enterprises. And you may find this article, the language, not only in your tax treaties but also in your local law. Now let's see what para B of Article 9.1 says. The same person participates directly or indirectly in the management, control or capital of an enterprise of a contracting state and an enterprise of the other contracting state. So we have similar wordings available in United Nations Manual, United Nations Model Tax Convention. So it is company A of UK, we have company B of South Africa and company C of UAE. And now company A participates in the management, control or capital directly or indirectly in both the companies. So company B and company C would be regarded as, or would be called as, associated enterprises. So in para 9.1a, it was only the direct relationship, that is company A and company B. Now in para B, it is company A holding or participating in the management, control or capital of two companies, company B and company C, and company B and company C, let's say sister concerns, would be regarded as associated enterprises. So Article 9 para 1 further says, so what will happen, once we are clear that the two entities are associated enterprises, then what it reads as and in either case conditions are made or imposed between the two enterprises in their commercial or financial relations which differ from those which would be made between independent enterprises. It is talking about comparison of conditions in controlled transactions with uncontrolled transactions, and we have discussed this in our first video tutorial, so I will not going to spend time on this. Now moving forward, it says then any profits which would but for those conditions have accrued to one of the enterprises but by reason of those conditions have not so accrued may be included in the profits of that enterprise and taxed accordingly. So it basically says, let's say in our example, when there is a transaction between company A and company B, so some profits which should have been included in company B are now forming part of company A, but in an arm's length scenario those profits should go to company B. So the tax authorities are allowed to include those profit in company B. For example, let's say this company B is supplying some raw material or some product to company A. So the market price of the product supplied by company B to company A is USD 100, but instead of supplying the product for USD 100 per unit, the company B is supplying for USD 80 per unit. So in this, what is happening, there is a drop in sale price, and accordingly the profit, that is the $20 which should be there in company B, is shifted to company A. So now the tax authorities of this company B, they are allowed to bring that profit back and tax in their own country. So this is what this paragraph is saying, and we have similar paragraph in UN manual. So if you wish to read it again, so it says then any profits which would but for those conditions have accrued to one of the enterprise but by reason of those conditions have not so accrued. So then any profits which would but for those conditions have accrued to one of the enterprise, that is company B, but by reasons of those conditions have not so accrued because it went to company A, may be included in the profits of that enterprise, that is the company B, and taxed accordingly. So the gist is the para 1 is applicable on transactions entered between enterprises with special relationships, and we're going to call these enterprise with special relationship as associated enterprises. Due to this special relationship, special conditions have been made or imposed between the two enterprises, that is transaction is not at arm's length. So in general, the company B would have exported the product for $100, but this company B is exporting for $80, so which is not the normal condition. This transaction is not at arm's length. Accounts do not show true taxable profit. So the taxable profit of company B in this case is less by $20, which is not true. Relevant tax authority can rewrite the accounts of the enterprise. So now in this case, the tax authority of company B can rewrite the tax accounts of company B and increase the tax profit by $20. But of which entity? Of company B owns only. So now we will going to discuss para 2 of article 9. But before that, let's revise what para 1 says. So para 1 basically allows tax authorities to carry out transfer pricing adjustment, wherein there is a special relationship, that is when two enterprises are associated enterprises, the terms and conditions in the transaction are not at arm's length, then article 9 para 1 allow tax authorities to carry out transfer pricing adjustment. Now what it will lead to? It will lead to economic double taxation. That is, let's say when company B exported product for $80 and not for $100, the profit of UK entity went up by $20. So assuming every other thing is constant, UK entity would be paying tax on this $20. And now if the South African tax authority says, hey, look, you should have exported for $100, which you have not done, so we are increasing your income by $20. So now this $20 is getting taxed in South Africa and in UK both, but it is getting taxed in two different hands. One in the hands of UK, and second in the hands of South African entity, that is company B. So this addition, or this the taxation, double taxation, is known as economic double taxation, when the same income is get taxed twice but in different hands. So para 2 deals with such condition. What will happen if there is an economic double taxation? Where a contracting state, say South Africa, includes in the profit of an enterprise of that state and taxes accordingly, that is, the profit has gone up by $20, they have done the transfer pricing adjustment. Profits on which an enterprise of the other contracting state has been charged to tax in that other state, and the profits included are profits which would have accrued to the enterprise of the first mentioned state if the conditions made between the two enterprises had been those which would have been made between independent enterprise. We have same wordings in the UN. Further, it says, then that other state, say UK, shall make an appropriate adjustment to the amount of the tax charged therein on those profits. In determining such adjustment, due regard shall be had to the other provisions of the convention, and the competent authorities of the contracting states shall, if necessary, consult each other. So very important paragraph. What it says, this paragraph 2 of Article 9, it says wherein, let's say the South African, the country South Africa makes an addition of $20. In such case, UK shall provide the appropriate adjustment. So that the same income should not get taxed twice. That's both in UK and South Africa. So it says then that other state, that is UK, shall make an appropriate adjustment to the amount of the tax charge therein on those profits. So it should technically reduce the income of UK by $20, which will have an impact that the same income is getting taxed only in one country, that is South Africa. But before this happens, the UK needs to be in agreement with what South Africa has done. So both the contracting states should be in agreement that if there is an addition in one country, the other country accepts the addition proposed by that other contracting state, which is very rare. So similar paragraph is there in the UN also. If you found paragraph 2 to be a bit complex, here is a summary for you. So paragraph 2 talks about wherein there is a rewriting of accounts by one tax authority, say South Africa, it will lead to economic double taxation, and in such case the other state, that is UK, shall make an appropriate adjustment. So paragraph 1 talks about when there is a special relationship, and due to that special relationship, the transaction entered between associated enterprises is not at arm's length, then a tax authority can carry out transfer pricing adjustment or addition, which will certainly lead to economic double taxation. So paragraph 2 in such cases that the other contracting state shall carry out appropriate adjustment. Such adjustment is not automatic, that is, until unless the other contracting state is also in agreement with the transfer pricing adjustment carried out by the first contracting state, it will not provide the benefit. So the paragraph 2 creates some sort of mandate, or I will say it talks about that the contracting states should try to resolve the issue, so it will avoid the double taxation. So when both the contracting states are not in agreement, let's say the addition proposed by South Africa is not accepted by the UK, then what will happen? In such case, one could see the double taxation, and in such case one will go to the mutual agreement procedure, file an application to the competent authority, and then competent authorities of both the countries will sit together and decide how to resolve the issue. Now let's move on to the last paragraph of Article 9. We do not have para 3 in Article 9 in OECD, but we do have para 3 in UN Model Convention. What it says? It says the provision of para 2 shall not apply where judicial, administrative or other legal proceedings have resulted in a final ruling that by action giving rise to an adjustment of profits under paragraph 1, one of the enterprise concerned is liable to penalty with respect to fraud, gross negligence or willful default. So UN says, when there is some severe issue, when there is a fraud, gross negligence or willful default, in such case the para 2 is not applicable. Para 2 talks about appropriate adjustment by the other contracting state. So in such case, if this is proved that it is a willful default or fraud, the other contracting state may say, hey look, I'm not going to provide you any appropriate adjustment. Hope I am able to give you some aspect of transpricing as given in the Model Tax Convention. I suggest you can go to OECD Model Tax Convention and read the guidelines or guidance issued by, or the commentary issued by the OECD and UN. It will be more helpful. Also, I thought it is a good way to share some good thoughts in addition to the technical. So thought for this slide or this video tutorial is, if you light a lamp for someone else, it will also brighten your path. This is by Lord Buddha. And if you have any query with regard to this video tutorial, feel free to write an email to me. My email address is Gaurav, Gaurav @jgarg.com. You can also send me WhatsApp. My WhatsApp number is 9899994934. And if you're writing from outside India, do not forget to add my country code, which is +91. If you wish to call me, you need to follow the time which is given in my email to you. On those time slots available, for sure you can give me a call. Thank you. See you again. Bye.